Before starting the video, click the subscribe button and turn on the notification bell. Hello and welcome to House of Commerce. Today's video is made upon the request of many students that they were asking what are mutual funds and how we can earn the profit from mutual funds. So by watching this video, you will get the complete concept about what the mutual funds actually are and how you can earn the money by investing into the mutual funds. So stay tuned and watch the whole video so that you can understand about the concept of mutual funds. So firstly, you get to know that what is mutual fund. Mutual fund is a collective scheme which is managed by an asset management company which is licensed by Security and Exchange Commission. So what does this asset management do? It collects all the money from the investors and invests it into the different securities and then earns the return on it. And then the return is given back to the unit holders, to the mutual fund holders. This chart can explain you better what the mutual funds actually are. Firstly, the investors pool their money to the fund manager or asset management company. Then that asset management company invests that amount into the securities, and then upon that securities it gets returns, and that return is passed back to the investors. So this is how a mutual fund works. Now the question arises that why to invest in the mutual funds? So the answer is that everyone is not expert in investing into the shares in the stock markets and into the securities, and they don't have idea that how much a security or a share earns. So an asset management company is run by the financial professionals, so they have idea and they analyze each and everything regarding that securities where they are investing in. So they have all the expertise about the securities, about the shares, about the stock market, so they invest in that securities which can give a good return to the investor. So that is why this is a much safer plan to invest into mutual funds via or through AMCs, asset management companies. Characteristics of a mutual fund. So how the mutual funds are different from other securities. So number one characteristic is that unlike other securities, there is always a willing buyer for your mutual funds, your units. How that asset management company can redeem all its units, can buy it back from the unit holder. Means if you want to sell your units, you do not need to find the buyer. You can sell it back to the asset management company. And the investment portfolio of the mutual funds are managed by separate entities known as asset management companies, and that are licensed by the Securities and Exchange Commission. So they have the license and they can repurchase their units from the unit holders. Valuation of mutual funds. So how the mutual funds are valued? They are valued at NAV, net assets value. So how the net assets value is calculated? It is calculated current market value of all the assets, means total assets the asset management company has, minus all the liabilities and divided by total number of units outstanding. So in case the company has a sale load, then it will add the sale load into the NAV. Sale load means the load or the amount, the commission which is given to the seller of the mutual funds. So if the company does not have, so it shall not add that into the NAV. And the selling price and the redemption price is updated daily by the asset management company. So the very basic question which you are here for is how the mutual fund can increase our wealth. So number one, it can give you the dividend payment. So dividend means income over your mutual funds. So it depends upon the category of your mutual fund which you select, that how it pays the dividend on monthly basis, on quarterly basis, and it can be on annual basis. On number second, the fund can earn by the capital gain, and it can give you that capital gain. So how the fund earns the capital gain? If it sells the securities which are increased in price. So when they're increased in price, the fund will distribute all that capital gain into the unit holders. Then increase NAV. If the market value of your NAV is increased, for example, you purchased the unit at 100 rupees each unit, then the market price increases after 10 days or 1 month. The market price increases by 100 to 110. Then you can sell your units to anyone or back to the AMC. Then you can enjoy the benefit, you can enjoy the profit of the increased NAV. Types of mutual funds. Open-end. Open-end mutual fund means that it has not a fixed pool that how much can be invested into the fund. So there is no limit to what extent you can invest the money. So the fund continually creates a new units and continually it can redeem the old units. Then closed-end fund. Closed-end fund means that it has a fixed limit like shares. So it cannot increase investment more than the benchmark rate. Then let us discuss about types of fund in detail, that how many funds are there. Equity fund. This is supposed to be the most risky fund that because it invests in stocks and shares. So equity fund means that it will invest 70% of it into the stocks and shares, and whenever the stock market rises, so the fund price shall rise, and when it will fall, the fund price shall fall as well. So that is why it is supposed to be most risky fund. So while investing, you must have to see the offering document of the fund, that does it invest into the equity market or not. Income fund. So this fund is considered as less risky than the equity funds because the income fund invests into the term finance certificates, into the government securities and treasury bills. So this has less risk than the equity because government security bonds and treasury bills and all that does not have a decline in the value as shares and others. So while investing, you must see the offering document that does it invest into the income funds, and so that you can earn a profit on it. Money market fund. So this type of fund does not have much risk than others, or you can say that it contains zero risk factor because it invests into the short-term securities and into the government bonds and certificate of deposits and commercial papers. So it maintains the highest liquidity than the other funds. So it has no risk at all and it can give you profit only. So this type of fund has no risk, and newcomers who does not know about the market strategies and all that, so they have a plan to invest into the money market funds. Asset allocation fund. So this type of fund invests all its net assets into the equity market, into the stocks and shares at any point of time, and it does not keep any liquidity ratio like equity funds. So that is why it is the most risky fund. So whosoever does not know about the market should not invest into the asset allocation funds. Capital protected funds. So this is a type of fund where all the investment is protected because this type of fund keeps major amount of its investment to the bank as a term deposit, and the remaining investment is invested into the instruments stated into the offering document. So this is the less risk averse fund. So who does not want to take any sort of risk while investment, so he can invest into the capital protected funds. Commodity funds. Commodity funds enables the small investors to take advantage and increase an amount of commodities. So it invests 70% of its investment into the commodities like gold and other things. So whenever there is an increase into the commodities, so the investor gets the benefit and gets the return on it. So this is the most beneficent fund for the investors. Now let us take a look at what type of risks are there while investing into the mutual funds. Market risk. Overall, the market risk is greatest potential danger for the investor in the stock funds because stock prices fluctuate due to the circumstances of the country. So the stock markets fluctuates very much, and due to that fluctuation, the investor may feel it risky to invest into the stock funds. Credit risk. The risk that issuer of the security, for example the TFCs held by the mutual fund, fails to meet its debt obligation. So if it is downgraded by any of the credit rating service, so that will make the fund suffers the loss. So while investing, you must see that if there is a decline or there is a probability that the TFCs or like securities shall have a decline in the future. Interest rate risk. So this is a type of risk which is suffered by the funds which invest or which deposits its money to the bank or to the longer term deposits. So this is a risk which is suffered by them because there is a change annually into the interest rate, and if it has given with a fixed term to any bank, so that will suffer a loss because there is a change with every budget into the interest rates. Liquidity risk. So this is a type of risk which arises when you have a thinly tradable securities which cannot be traded or which cannot be sold easily to the market. So when you have such type of securities, you cannot sell it back to the AMC or you cannot sell it into the market because it does not have much demand into the buyers. So whenever you purchase any security which is thinly tradable, so that will suffer a loss. So what to do now? You have to discuss with the broker or with the AMC that which security has much saleable or repurchasable value. So you should invest in that security.